Aberdeen Standard Investments is a world-class global diversified asset management firm, one of the largest asset management firms in Europe. We have around about 1,000 investment professionals across 50 offices around the world and clients in around 80 countries around the world. We have broad, deep skills in equities, fixed income, real estate, multi-asset and solutions investing, as well as a range of alternatives. So at Aberdeen Standard Investments, we have a very collegiate approach to the way that investment funds are managed. We don't believe in star portfolio managers, so it is a very team-based approach. Remuneration is a mix of annual base salary plus bonus. This is very subjective or qualitative in the way it's determined. It isn't formulaic, and we believe having that more qualitative approach to remuneration creates a better environment within the team and therefore better investment outcomes for our investors. The formal investment objective of the fund is to provide high capital growth over the medium to long term. We think this objective is far more aligned to what the average mum and dad investor is trying to achieve, where they're trying to build their wealth in order to fund their retirement. So the objective is deliberately benchmark unaware, benchmark agnostic, but informally, internally, we also aim to outperform the benchmark as well. And that objective is to outperform by around about 3% per annum over rolling 3 to 5 year periods, and that's before fees. So our investment philosophy believes that markets are inefficient and that superior returns can be achieved by holding high quality businesses at reasonable valuations. And so that forms the core of our investment philosophy. Beyond that, we believe that benchmark unaware returns are far more important to the average investor, and that's a cornerstone of the way we invest also. We have a very research intensive bottom-up stock selection process. We have relatively large, stable investment teams on the ground in these countries and regions around the world. And our investment process is really three-stepped. The first is to analyse almost all companies within the universe and assess them on a quality basis. And that really becomes a pass and fail filter for us. So the different measures we hold close in terms of defining quality are things like the quality of the management team, the clarity of the business strategy, and ensuring that the financials are also quite sound. So we typically look for lowly geared balance sheets. Once a company passes that initial quality filter, we then conduct a whole range of valuation measures on that company, things like price earnings, dividend yields, other valuation measures such as those, and really apply those pragmatically for the individual circumstances of that company, of that sector and of that country. Once we have that relatively high quality subset and put those companies through that valuation process, we then look to portfolio construct in a relatively benchmark unaware approach. So we don't start with benchmark weights in terms of stock, country or region. We start with a blank sheet of paper and really looking for 40 to 50 high quality names that aren't trading at expensive multiples and trying to ensure that they're diversified across sector, country and also theme in a more absolute way. Meeting management of an investee company is really important to us. We wouldn't invest in a company without having met management at least once or twice. And there's many examples where we've met management 10 or 20 times before we've actually made an investment in that company. Really, it's an important part of our quality step in the process, understanding the quality of the people involved at a management level, but also at a board level. And that's something we hold quite close to our hearts in terms of assessing companies, is having that faith in those people managing these businesses for us. So an emerging market is defined as one which is generally experiencing higher than normal economic growth, certainly generally more than a developed market, but also has relatively stable geopolitical and legal systems. And that really is the combination of those two things really is what makes emerging markets attractive. The major emerging market regions around the world, certainly most of Asia, if you think China, India, Indonesia, these types of countries, most of Latin America, Brazil, Chile, Argentina, parts of Eastern Europe, so Poland, Turkey, even Russia, and then a number of countries in the Middle East and in Africa, places like South Africa and a number of the Emirate states as well. So some of the benefits of investing in emerging markets are that these countries and regions of the world are typically much higher growth than other more developed markets, and that can lead to superior return outcomes from investing in their equity markets. They typically have younger, harder working populations with high savings rates, and these can be very strong tailwinds to that economic growth. So some of the risks investing in emerging markets are that these countries and regions of the world are still developing. They aren't as developed as most of the Western world. They have relatively higher rates of growth, and with that growth can come instability. The equity markets and also the currency markets can be a lot more volatile than what we normally expect in developed markets. And so that can be a risk for investors, but on average we believe that investors are compensated for these risks with higher returns over time.